Hello and welcome. This is Robert Schein, Managing Director and Partner of Blanke Schein Wealth Management. Today is Friday, the 29th of January, 2021. It's our Friday Insights edition. It's where we explore topics or answer questions in greater depth that clients have asked or that you have interest in. And this week we're going to talk about the earnings expectations as well as what's in earnings and how does that ultimately relate to stock price or have an influence or an effect on stock prices. So let's get into our Friday Insights. Thanks for watching. So if you follow my daily updates, I also talk about what traders are watching, what Wall Street is paying attention to, and ultimately they're always watching earnings. Corporate earnings, we're in earnings season. We just concluded last year's fourth quarter, if you will, at the turn of the calendar year. Begins a new year and a new quarter, but we're waiting for earnings to be reported by all the Fortune 500 companies, big, small, as well, and those companies around the world as well. So earnings now are being reported in the middle of January, February, and even as late as March. And as companies report, as I said before, if you're watching, we have markets are priced at all-time highs right now from the S&P, the NASDAQ, and even the Dow Jones Industrial Average. And earnings expectations, are below what the prices are. So what we're going to have to see is either the stock market sells off and gives back, and we call it basically coming back a little bit to meet where earnings are, or as we have corporations report, they provide the earnings results, how they did in terms of their sales and their net profit. We're going to go through an example of that. But more importantly, the guidance that they'll provide as well. So how did they do, especially in a post sort of pandemic world on a go-forward basis? What insights will they give us, and how do earnings affect ultimately the stock price? Well, what we want to keep our eye on are essentially, let's go to the board here. Let's take a look at this. So this is a business, a P&L, if you will, profit to loss statement. And this is how businesses are evaluated, if you will. Revenue or sales is the top line. In this case, I just used $100 as the top line sales in this example. The next is the cost of goods sold. You might see that as COGS, as referred to in the accounting world. And ultimately, it's everything you need to actually sell this good out the door, from anything from your marketing all the way down to obviously your human capital, if you will, the people that you have to ultimately, whatever business you're in, make this sale happen. So make this revenue happen, you need sort of cost of goods sold, and that's ultimately on a line item on your P&L. You minus that, so the 100 minus the 50 is a $50 gross profit. It's a gross profit because we still have to take out a lot more. And then you have the operating expenses, which is a SG&A line. It's another ultimately accounting term, sales, general, and essentially administrative. Anything else you want to put down there goes in this line. Let's say $25 minus the 50 of the gross profit leaves us $25 remaining. And that's called your operating profit. And that's before depreciation, interest, and taxes. Let's throw $13 just as a proxy there, plus or minus here. On this example, that gives you a net profit or free cash flow of $12. That's the most important thing. In fact, if you actually watch anybody on Shark Tank, they ultimately want to know this number minus all of this and what your free cash flow is. And then they take a multiple of this depending upon what business it is. If it's a growth business like a technology company, it has a higher multiple. Or ultimately they'll take a 10x. So they'll say that this business right here, I'll give you a second. What do you think this business right here, based upon this example, is valued at? We would take the net profit times 10, and you're looking at $120, let's say, for this business that basically has revenue of $100 per year, but net of 12. Or let's talk about earnings. 10 shares outstanding divided by 10 shares. Okay, that equals $1.20, okay, of earnings per one share. Now let's think about this. This is earnings per share, $1.20 for 10 shares outstanding of this company. Let's call it a lemonade stand that the kids have at home, and they say, Dad, we want you to be part of this. Well, he just showed us an earnings of $1.20 per share, which is wonderful. Here's what can happen, and here's what corporations are doing, and this is what we're going to pay attention to, how earnings are affecting stock prices. The valuation of this $120 business, let's say it's priced at $150, and they finally have a result of ultimately earnings that are in the 120 business valuation. So market capitalization, how you value your business. Well, that's a disappointment, right? We were expecting gross sales, or at least net profit, to be much greater. Now, businesses can work. Actually, a lot of businesses out there you want the strongest management teams. Why? Because they can work anything in here, from growing the top line through new business units or new sales or new opportunities, or growth through acquisition or organic growth. Entrepreneurs and CEOs and C-level executives and management teams and leadership of corporations can work everything here, from increasing better tax-favored states to countries. We've seen corporations move as a result of that. That then affects your net operating profit, which then ultimately increases this number, right? Or your market capitalization. So what's happening is, because of business efficiencies, right here, cost of goods sold. Let's say human capital, right? We just saw the unemployment rate go super high. Right now we're at 6%. We started last year at under 4%, which is a 50-year low on the unemployment rate. So now, unfortunately, businesses had to let go of employees. Well, let's say you have now a reduced cost of goods sold because you don't have so many employees working for you now. And maybe your revenue is hit a little bit more, but you could still eke out a net profit. Or let's say they reduced their employee headcount and their sales grew. That means that the profitability happens. And you wait and see. We're going to see some of these earnings reports where some of these corporations use COVID, if you will, to reduce headcount, okay, to reduce expenses, right? Think about this. Corporate travel was down. No one traveled last year. So we're going to find out in the P&L or as they report their earnings, how they're going to eke out profitability. Now, let me give you an insight right now. What we're seeing in the early announcements right now of those who've already reported is we're seeing top line sales revenue growth exceeding all expectations in majority sectors and industries of the S&P 500. There's some sectors like travel and leisure. Obviously, small businesses need help and assistance, and hopefully Congress can come to their aid. But we're talking about a publicly traded corporation that have shares outstanding, and how ultimately their net profitability or their net profit earnings announcements affect their stock price. So if there's a disconnect from the valuation of what's expected, and it could happen by a couple cents per share, right? They could come down at 119 and say, oh gosh, it's not. And so that affects the valuation of the business itself. And that's how stocks move in relation to earnings. Earnings are actually the most important thing as we relate to valuing a business. This is a dividend company. They give it off to the shareholders by way of dividends. A growth company might just keep that. And that's the classification of a growth company. They would reinvest in their own company because they're growing at such a fast rate. So there's sort of a difference there. But right now, if we look at the Wall Street forecasting for free cash flow or earnings yields, they're actually forecasting a bottom in 2021. So right now, stabilization for all of the S&P 500, but an increase in the back half of 2021 and an increase in that earnings yield projected a lot greater than the 4% long-term average, about a 4.8%. And then 2022, 2023, in fact, is even a greater increase. So we are seeing projected, by way of what corporations are saying, what we see on Wall Street, earnings increase, even the net profitability or the net free cash flow. This is just one way to value a business. Keep in mind there are several different ways of valuing businesses out there. I just used a short form, simple way to explain ultimately our topic of the day for this Friday Insight. So thank you for joining us. We really, truly appreciate it. If you like it, share and subscribe. Share with friends and family. We always appreciate that as well. And then also give us feedback. Email us and let us know another Friday Insights, something you'd like me to go deeper on, and I can provide greater insight and explanation. So I hope you enjoyed this today and enjoy your weekend. Thanks for watching.